Hello, everyone, and welcome to another episode of Help Me Buy Property podcast. In the episode today, we are talking about how to create real estate business via property investing, be it passive property investing, transitioning into active property investing. In this topic today, we'll talk about these transitions and why is development an important part of these transitions, or property development an important part of these transitions. Stay tuned and keep listening to the very end. Thank you very much. Hello, and welcome to another episode of Help Me Buy Property podcast. Today, I have my co-host Cheryl Leong with me today. Well, when you're talking about the business of real estate or creating businesses out of property investing, what you're basically doing is you're transitioning yourself from, buy and hold strategies that pretty much the first-time investors would engage in. And what you're doing now is you're going into more buy, hold, and develop, or buy, hold, and renovate strategies. And typically, when you talk about all of these strategies, there are three key things that comes into play. And we'll go into a lot more detail, but very high level, there are three key things that comes into play. So you're talking about yield, growth, and return. And so for the listeners, yield is, of course, annualized, rental that you would get as a percentage of the property. So whatever rent it is. Growth is something that the market delivers to you, while you wait for that, demand to go higher, the supply to go low, and people start paying more for particular areas. The return is something that is literally very less spoken of, and that's the key to the transition. So return is where you're talking about manufacturing your own equity. Now, return could be as simple as you converting a 3-bedroom, 1-bathroom to a 4-bedroom, 2-bathroom. Return could be as simple as you building a granny flat at the back. But return could be as complex as you taking a full site, dropping the house and building 4 townhouses or 8 townhouses or 10, or doing a massive land subdivision. And so return could mean a lot of different things. And what you're doing there is you're not depending on the market to deliver the growth to you. What you're doing is you are creating your own profits at your own free will through property developments. And that's where you are almost creating a business of real estate via property investing. I call it a transition from passive property investing to an active property investing. And so I think the important question here is that who would be the key people for those this transition makes sense? Who are the people who would be looking for this transition to happen, like from buy and hold? Because it's not, we know that this transition is not for everyone, right? And we'll talk about even the not side in episode 2. And for listeners who are tuning in, this is part 1 of the episode. And so in the first episode, we are talking more about who does the transition makes sense for. Okay. And so let's talk about that, Cheryl, a bit. I would say number 1 would be the PAYG income earners. They would be at the top rank, at the top of the list when you're talking about transitions, because these are the people who wants to kill their single income dependency of, paycheck to paycheck living, or, living for the bills coming into the post. These are the people who would be like, I don't think that I can do any other business. Property is something that I can do so easily because I'm already investing in there, right?
Yeah, that's a really easy, well, I say easy, but not so. It does start with whether a PAYG person is willing to sort of go, I'm going to now take control over the future of my property business, and really go, what does that entail? And do I have the capacity? I guess that's something that we'll discuss. But there's being able to say, hey, as a PAYG, you've got the serviceability to be able to purchase more properties. But then again, your serviceability is going to be, it's got a ceiling. It's got a ceiling as well, right? So we want to be able to go, okay, well, if we create another business, another income stream that's going to push up your serviceability, then the PAYGs are the easiest cab off rank. But it does come down to that initial willingness and the desire to actually go, I'm going to get a bit uncomfortable, because it does involve a bit extra effort. It does mean that outside of your day-to-day, you're going to have to be creating this other income stream and other business. So I think that's the
Definitely.
first part,
Yeah.
even for PAYG, to sort of think, okay, well, am I okay? Am I comfortable just sort of doing the buy and hold, or am I ready to be able to challenge myself, then take it to another level? And there's no judgment in here. It's horses
Yeah.
for courses for everyone. It's everyone's priorities, right? It comes down to the priorities. So I'd say it's the first thing for the PAYGs is to anyone really wanting to look at making that transition is, are you committed? Are you committed to actually creating this other stream of income through a property business to increase your wealth and income?
Definitely. And you're absolutely right. I think risk and dedication and the commitment comes at the top end when you're talking about creating this business on the side. Of course, one of the reasons that the PAYGs are the first cap of the ranks is because these are the people who would usually not have any other businesses on the side. And so of course, the grass is always greener on the other side. Especially when I talk to PAYG income earners, they are so excited about starting up their own business or creating their own business. And you see, people attending a lot of property courses or property development courses in anticipation that, okay, maybe that's the foot in the door for them to be called, business owners. Okay. And that's a good excitement. That's an amazing thing to do. But of course, it's very, very important that they understand their risk appetite as well. The other thing also, when you're talking about people who would transition, are people who are quite actively thinking about their retirement planning. Of course, again, this is an extension of, people with finite income. So, and I call it business owners who have infinite income because they have infinite possibilities. People who are dependent or working in other businesses almost have bounds to their income as to how much they can grow every year. Okay, because what they're doing is they're using their hours and trading it towards salary. And so it's important to understand that these would be the key people who are thinking about their retirement continuously. And they know that, with that slight increase in risk, they could potentially do it safely and securely if they have the right strategy in place for them to transition from a passive property investment strategy to an active property investment strategy. Let's talk a bit about the transitions side of these, the benefits of the transition of not doing buy and hold, but you're doing buy and develop. One of the key things that I can really think about from a transition perspective is, you are creating profits or manufacturing your own equity at your own free will. And, taking control of that is quite important when it comes to property development. You know what your profit looks like, being mindful as to, okay, these are the key things that you do. And if you do that, you should be able to hit a profit at a particular point. Of course, the education is quite important and quite key when you're talking about business of development or business of property. But taking that gamble out of the property market, be it renovations, be it through developments, be it through small scale developments, is one of the key benefits that I see of you transitioning it out of buy and hold strategies. What other benefits that you can think of, Cheryl?
I'd say even from a personal satisfaction point of view, and I know this is a bit touchy-feely, but, you've talked to sort of the mechanics around it going, it's where from an income perspective. But I think a lot of people have this inner urge to be more creative, to create as well. And this allows people to do that in a space where, if you've got property and you're renovating, that you're managing some level of risk. And I can, it's almost a bit of a dip your toe in the water of doing something that's outside of your comfort zone without breaking the bank, so to say. So I would say that's one of the things where people are going, I want to create a business outside of my normal income, but I don't want to have to create a whole new idea or anything else. Real estate has been around for thousands of years. It's, there's been proven formulas. That if you're following some sort of a formula that you are getting mentored or you're getting guided, realistically, you can't go too wrong, right? You need to manage that risk. But I think, like I said, for people who go, I don't want to have to think up a whole new idea of the next Amazon or whatever. This is something that that they can still get their hands into. What do you think about that?
Yes, 100%. And I think what you're referring to is the replicability of, you doing the business quite easily and quite quickly, right? And so one of the things that I was mentioning to a client the other day was, when you think about property development in specific, you're not chasing a client. You're not chasing potentially prospects to grow your business. All you're doing is you're finding the numbers where it works for a particular property, and you're acquiring it and creating more value out of that property, out of that particular strategy that you're following. And so that sense of completeness is quite important. That sense of knowing how far can you go with that business, if you know it correctly, if you're doing that transition correctly, is quite the key. Because what you're doing is you're very focused on creating cash on cash returns. You're very focused on, creating that money machine without being, running for sales or marketing, etc. Of course, there is a portion of sales and marketing that comes through property development as well, right? Because you have to ultimately sell the product that you're building. But it's not so much about running after the sales for the clients or bringing the prospects in, etc. All of that. And so I truly felt, especially from my own transaction perspective, when I did the transition from, buy and hold strategies to buy and develop strategies, there was a change in mindset, which was very, very important. And I know we have talked about this in one of the earlier podcasts, in relation to killing the serviceability dependence, creating the cash flow, and doing all of that, knowing that it's so easy to do if you know how to do it. And of course, we'll talk about that as to how to do it. But there are so many different things and you can do in the world of property development, where you can create instant serviceability for yourself through rooming houses, for example, or you can, do small scale developments quite quickly and create chunky cash or cash on cash returns quite quickly. You can leverage your own relationships by being part of other people's projects. And so one of the key things that I always say to people is, it's not so much about you transitioning out of buy and hold and doing property developments fully. It's about mixing the best of the two worlds together. Okay. And so if you do that successfully, you would get the benefits of both worlds. It's not so much about either or. I think a lot of people think that, if I do property development, I'm going to just do developments and I'm not going to do buy and hold. That's not really true. Because buy and hold is still important, because land banking is important. You need to be sure that you have future projects in the pipeline with you, so that if you're finishing one, you're going into the other project pretty much right away.
So, Moss, I want to ask the question, and I'm sure this comes up all the time, where people are doing buy and hold, and then sort of looking at, what's the difference between sort of buy and hold and waiting for the market to pick up versus buy, hold, and the risk of development. What are your thoughts around that?
Yeah, definitely. And look, I think the important thing is that buy and hold is great. And so we're not saying that don't do buy and hold. The idea is that the next step of buy and hold is to buy, hold, and develop. And it would be great to understand this with numbers. And so if you assume that, there are, say, two people, and in both these scenarios, you're talking about 4 properties, and each property is worth, say, $500,000. In the first scenario, we are talking about a person with a $2 million portfolio, and a second person, we are talking about a property portfolio of $1.5 million plus that extra 500 that they are going to use to develop. Okay. And so if you look at, the Australian average growth of, say, 6% across the years of, say, 10 years, you're talking about a portfolio value of person A, which goes from 2 million to 3.6 million. Okay. Assuming at a deposit of, say, 20%, they would have an equity growth of roughly around $1.6 million, which you take away and understand from cash on cash perspective, you're talking about 30% cash on cash. Okay. Great. There's nothing wrong with that. Okay. The important thing in this scenario with this person is that, the 5 properties that they're acquiring, or the 4 properties that they're acquiring, are all selected the right way. And so they're all delivering the returns that we are talking about. Okay. Now, if we take that example and assume in the person's B scenario where they're transitioning into property development, all they're doing is they're still doing buy and hold for 3 properties, but they are using one of the extra properties to push developments on it and create that extra amount of chunky cash coming back to them. And we know that an average development when you look at the profits, you would be looking at absolute profit of $200,000 to $250,000 bare minimum on a smallest possible deal, right? Because, for deal to be worthwhile, that is the sort of money that you would be generating. And so if you assume the same scenario of 6% yield over 10% or over 10 years, what we are talking about is the 30% cash on the first 3 properties. But the beautiful thing that happens with that extra money that you generate, say 200 to 250,000 every 2 years, for example, if they're doing that development every 2 years, that provides an extra $800,000 on top of the overall scenario that they have. And so in this scenario, particularly, their overall portfolio gains comes to almost like $2.9 million. So you double the wealth compared to the same person who is doing buy and hold, right? And so all you're doing is you're absorbing little bit of risk while, pushing your, net equity or net growth on super steroids. And we're not talking about, developers who are doing this on a regular basis. You're not talking about developers who are scaling themselves from $250,000 developments to, $2 million developments, as they grow their portfolio quite on the development side.
Yeah.
And so that's, the idea is to do it safely and consistently when it comes to development, right? It's not so much about, I do one development and I don't do anything, right?
Yeah. And so and again, the conditions are obviously make sure you do your numbers, not all the time, it's not always that you're going to hit 250,000 in each deal. And
of course.
So, all these are conservative and we're just creating scenarios, but it's more to be able to say, hey, you can leverage without it being a huge risk exposure to you as well.
Definitely.
Particularly if you're looking at properties where, you've got an existing property, you might renovate the front and then develop a duplex up the back, something like that. You still have an asset. You still have an asset and a value of the existing property. So, there are various levels of risk exposure when you're doing development, which doesn't necessarily mean that you're knocking down everything and starting from scratch. So it is more like, okay, what is your risk appetite? How do you manage that risk? And then be able to ensure that you've got great returns that come out of it. If you are so inclined to want to move from a more passive investor to a more active investor /
100%. And you would see people arguing, right? And I hear this question all the time, and people say that, if I would have done the development or if I would have held the property for the same amount of time, I would have made the same amount of money. And that talks to the core of the question or the answer that you're talking about, that, you haven't educated yourself, you haven't done the development properly, you haven't done it so that, you can exactly know what a development profit and a growth profit looks like. And so if you're doing the development numbers properly and understand the development as your development profit should be, exponential or on top of whatever the growth profit should look like. And so, it comes back to, making sure that, you understand what you're doing. You do that level of due diligence, you understand the risks, you protect your margins on the developments, etc. Making sure that, you're doing it safely and not taking excessive risk. And so it comes down to, yes, you can create generational wealth, you can build a secondary business, you can kill the dependency on the serviceability, you can have a business that, can travel generations for your kids, etc. But you can't discount the risks that comes with these transition, right? Of course, people talk the good side, but they don't talk the bad side of this stuff as well. And so let's talk a bit about, what are the risks and the transitions, or what are the mistakes that people makes in these transactions that you see all the time. And ultimately, doing it safely not only requires education, but experience, right? And so forming JV or forming part of those, deals where, there is experienced people whose job has been, or whose the whole lifestyle has been delivering these projects, get yourself known to some of these things. I always say this, that, people naturally, when they are stepping into development world, they feel that, okay, this is progression, this is progress. Great, right? But one of the biggest pillars of resistance of the progress is these three words that you keep hearing that people say it's not necessary. No, everything is necessary when it comes to development. When you talk about development, you can't just skip the hoops. This is not so much buy and hold where, you can sell it later and still recoup the money, or, you could sell it later and still break even. Development, a bad development can actually wipe the asset base completely away from you, right? And so you hear so many horror stories.
Yeah, and you get stuck halfway through a build, no one wants to touch it.
Definitely. And so there is a massive holding cost where it's not just you being impacted by this, your family is being impacted by this. You are in a completely different mindset. And so if you don't have that strong support group, you would be struggling quite significantly. And so a lot of people think that when you go into these developments, it's all that chunky money. And so they have this 400 or 500,000 sitting on the side. They'd be like, okay, I'm going to go out and do developments. No, you need the cash flow is still as important and as relevant. And if you don't have that cash flow coming through, the market can take turns, COVID, no COVID, interest rate rises, and you can be in a position where you have to hold. And if you don't have the capacity to hold, you can see yourself burning through cash, which would be a profit, right? And so it's important to understand and relate to some of these as to the transition is great. It's awesome. You can make a lot of money, but you can burn a lot of money if you don't have the proper strategy in place, or if you're not doing it with proper people.
You raise a good point about, and I know I mentioned around just understand what your capacity and your own resources and all of that. Like the point of having JVs, it doesn't mean that just because you don't have the time or it's not the priority, like development has so many aspects of it, right? So you can joint venture if you've got the cash, but you don't necessarily have the skills or have the capacity to do the day-to-day running around and project management, joint venture with someone. So
definitely,
there's always a solution around it. It's all around how much, how committed you are to make it happen. You can make it happen. You just have to sort of go, massage it a bit to form the dough so that it can rise. It's just adding little ingredients. So I think that's a really important point you raised.
Definitely. No, 100%. And I think one other mistake that I always see people making, especially when they are in the transition or when they've made the transition, is that because they are not doing buy and hold, they move completely into this, this mindset of, okay, I'm going to do developments on the ongoing basis. They don't think about their own pipelines. And so what they do is they go into this, phase of in desperation because, you might have quit your job, for example, in order to do developments. And you see, people talking about quitting jobs and becoming a full-time developer. Great. But it creates this sense of, okay, I need to make enough money to put the food on the table. I need to create that sort of cash flow. And so you sometimes end into this desperate state of, doing a development where the times might not be right, or you might not be able to find the right property. I was speaking to a developer, a friend the other day, and, a lot of experience. This guy has, over 14 years of experience in doing development, right? But the problem was that they wanted to jump onto the next site, and they were so desperate to kick it off that they were looking at deals that they shouldn't be looking in the first place, right? And so a deal next to a power line, a deal where that you cannot, reestablish the GRV or the sales, you should not be cutting corners. It's everything is necessary, again, to the same point. And so, again, people who are taking the transition, you need to ensure that, you don't just forget buy and hold and do completely, property development. It's a cycle of doing both and doing both successfully while creating cash flow for yourself.
Yeah. The one point that I realized also is, particularly I'd say business owners and less so PAYG, because PAYG generally you've got some level of serviceability. And this is not so much the risk. It's more so just because you're starting up a business or you're in business or whichever, don't feel that you can't go into development because you don't have serviceability.
Yes.
Because we are so accustomed to think that before we can go and buy property or whichever, that we need to have serviceability and we need to have the income in order. I guess the benefit about development, and depending on the scale of the development, that you can leverage commercial lending. You can be more creative with your finance.
Yes.
You have some cash, someone else has serviceability. So right? This is it. It's more a comment towards the pros of development and to not let the serviceability hurdle be the thing that stops you. Because as I've said a few times, it's about finding solutions.
Definitely. And so one of the ways that, again, coming back to the pros, that you are killing the serviceability dependency by going into the development is because when you are looking at commercial financing and what you're talking about is that it's all about the deal in itself. And so what your exit strategy is, who your builder is, who's your development manager, how much profit is in the deal. And the deal itself is looked at and funding or the construction finance is provided against the deal. So it's not you as a person who can actually service the loan. It's about the deal in itself and how profitable the deal is. And so, that transition helps people break away those ties from serviceability and, excel in making more money. I was talking to my wife yesterday and we were talking about something completely different and random. And I said to her that I've been pondering about this, that, as a kid, you hear people say that money makes money. And you truly think about how money can truly make money when you start doing developments, because you can scale up so fast. You can see that, 200,000 might not get you where you want to get to, but, 500,000 gives access to you to better deals, bigger deals. And so, of course, bigger deals means bigger risks. And so how do you make sure that, you are, safely and securely cutting the ties from serviceability while going into, property development space and creating more net wealth for yourself? Ultimately, that's what the outcome is that everyone is trying to reach, right?
Yeah. And again, on that point is the mindset around, if you've got some money, but even if you don't have money, right, there's what we call other people's money,
yes,
which you can leverage
definitely
to make money as well. So it all comes down to, if you're what you're trying to achieve. The whole point is the more that you educate yourself, the more that you network with people and surround yourself with people who are of a similar mindset, where it's all around problem solving. It's all around finding solutions. Deals can happen. And so if the intention is to be able to go from the typical buy and hold, again, a great strategy to be able to go to another different strategy where it's a little bit more involved, a little bit riskier, obviously can be managed. It is just a matter of like, what do I need to do to make it happen?
Yes, definitely. And to close off the conversation, look, I think one of the important things that we discussed at the start of this episode is, when you're talking about developments, you don't want to, or you don't need to start with a bang, right? Everyone thinks that I need to do a 4-unit side or a 6-unit side or a 3-unit side or even a duplex, right? You don't need to. You can start really, really small, save the property at the front, build one at the back, change the configuration of the house, a 3-bedroom, 1-bathroom to a 4-bedroom, 2-bath, or do a conversion, create a single isolated self-contained 1-bedroom unit and a 3-bedroom, 1-bath, the smallest sort of developments where, you're only spending $20,000 to $30,000 creating an equity of, about 100, 250 in some scenarios, right? And so it doesn't have to be with a bank. You need to be slow and gradual in making sure that, you're taking baby steps towards the bigger developments. Thank you very much for tuning in. Keep smiling, keep investing. This is Moxin Cheryl checking out. Adios.
Ciao, ciao. Bye.